Hi everyone, this is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast. And today's special guest is a returning guest. He's worked in the hedge fund industry for over 25 years. He's been writing the popular financial blog, The Credit Bubble Bulletin, since before the technology bubble burst. He's a portfolio manager at McIlvaney Wealth Management's Tactical Short Fund for retail investors, and he's a follower of the Austrian School of Economics. Doug Noland, thank you for joining me again.
Hi, Jason. Thanks for having me back.
Now, Doug, since you cover the Credit Bubble Bulletin, you've been doing it a very long time. I want to ask you how many different credit and asset bubbles you think there are now?
I need to write out a long list there, Jason. Well, my view is that this is, the biggest bubble in history. I started chronicling this phase of the bubble, and back in, I guess it was April of 2009, I referred to it as the global government finance bubble. At the time, I was saying, okay, the bubble now has gone to the heart of money and credit, to central bank credit, to government debt, to sovereign debt. It's gone global. It's, U.S., Europe, Japan, China, the emerging markets, and over the years, it's been obvious it's gone across asset class. Basically, all financial assets, I believe, now are in a bubble because of the distortions from central bank credit, interest rates, government debt, etc. But also, it's gone into real estate markets. There's not a lot of talk about that here in the U.S. now, but if you look at the markets in Silicon Valley and Seattle and some of the other hot markets, I mean, the prices are even significantly above where they were back in 2006, 2007. So to me, the bubble is everywhere almost, unfortunately.
Yeah, I agree. It's basically the everything bubble that a lot of people in the hedge fund community have named it. If I could add to your points there, the Washington, D.C. metro area has an enormous real estate bubble as well. There's nonstop construction cranes here, and they're building further and further out luxury single-family homes and condos and townhouses all over the place. So further and further away from D.C., and the prices just never seem to go down. But tell me if you notice this as well. It seems, Doug, that there's a lot more of these asset bubbles and credit bubbles now that are over $1 trillion in size. And I really don't remember this before the 2008 financial crisis. Is that correct in your view as well?
Oh, absolutely. This is so beyond what we saw back. And during that period, Jason, I referred to it as the mortgage finance bubble. And I chronicled that bubble for, a number of years. But it was centered in mortgage finance and, real estate prices. Today, it's, again, across all asset classes, and especially, you mentioned Washington, D.C., but I would argue that commercial real estate is mispriced almost across the country and in a way almost globally. And that's a reflection of the collapse in 10-year yields, for example. So part of the yield chase has been, buy commercial property and get an income on it, and that income stream is better than Treasury, so it makes sense. And that calculation disregards valuation or what can happen in the downside, because commercial real estate in particular can go through really, really difficult downsides. We've seen that in the past.
Now, do you think the commercial real estate, a lot of it has to do with the problems in commercial real estate? A lot of it has to do with the problems that retail is having, how a lot of U.S. middle-class consumers just don't have the high-paying full-time jobs and the discretionary income? Yeah,
and that's part of it. But I would argue the biggest issue is just overinvestment, overbuilding. I remember arguing, 10, 15 years ago that we were overbuilding in retail, and we just kept building and building and building, and we're so overbuilt in real estate or in retail real estate that I think that's a huge issue. I think there's reasonable demand in retail right now. It could deteriorate significantly in a recession. So I don't think as much demand as it just is oversupply.
Yeah, I mean, we've seen a lot of problems with a lot of the bricks and mortar retail companies. So, Amazon's obviously doing very well in terms of revenue growth right now, but a lot of the shopping malls are not doing as well. Sears is having enormous problems. The old bricks and mortars are getting their lunch eaten by a lot of online retail companies, e-commerce. And what else I noticed too, Doug, is it seems that a lot of these middle-class casual dining sit-down restaurants, the chain restaurants in particular, they way overexpanded for years since the 2008 financial crisis. And we haven't seen nearly, in my opinion, enough of these restaurants go bankrupt yet. And there's still an enormous expansion. I don't know if you're familiar with Danielle DiMartino's work, but she's been saying for about a year now that some of these restaurants are still growing, opening new stores at like 2 times the GDP growth. It's insane.
Yeah, and that's just, that's a consequence of, too much easy money. And I like to, use the example of Amazon. Obviously Amazon has grown into a behemoth that, is taking down a bunch of retailers. Well, Amazon, they made very little money for years, right? But because the financial conditions were so loose, they could borrow all the money they needed, and it didn't matter if they were that profitable. They could just keep expanding and building their franchise. And at the end of the day, it's part of this overbuilding and bricks and mortar. Obviously they're paying a high price for that, but it's kind of a consequence of years of mispriced finance and too loose of credit conditions.
I agree that Amazon doesn't have as good of financial fundamentals as a lot of people would claim it does. Their accounting is actually all non-GAAP, but they've been just growing revenue like you said. Actually, one of my friends, hedge fund manager Dave Kranzler, I don't know if you're familiar with his work. He wrote like a 15-page research report saying it's a Ponzi, it's a fraud now. But I mean, as long as the stock doesn't crash, they could basically get away with it for a long time.
Well, they've done an incredible job, right? And I'm an avid purchaser on Amazon, as a lot of people are. But my point really is that they were able to grow like they've done because of loose finance, right? In a normal environment, the market wouldn't have lent them so much money because they weren't that profitable, again, for years. Now they have such market power that they're finally making some money. But considering how big they are, I mean, the margins are pretty thin. And, it's not the easiest business.
Yeah, I agree. I think Tesla Motors has taken advantage of the loose financing conditions as well, because they haven't even delivered cars on time. They're nowhere near profitability. Normally, the car industry, and we could talk about this too as well with the subprime auto loan bubble. And normally with the car industry, it's not a high margin business, and people are throwing money at it still. And I'm just scratching my head because Elon Musk is basically, he's admitted he's bipolar and he has all these crazy harebrained ideas, and none of which seem to be anywhere near making money.
Well, I guess so many people have made money in Amazon that they would look at Tesla and say, okay, this is the next Amazon, and we don't have to worry about them making money because down the road they'll have dominant market share and eventually make money. The big surprise could be if all of a sudden financial conditions tighten, credit conditions tighten, then it's a much, much different story for a company like Tesla that burns through cash like it does. So that's a stock to watch because the environment is turning, as I suspect it is. That I would imagine the market would become increasingly nervous on the finances of that company.
Now let's talk about the subprime auto loan bubble. It seems to just keep getting bigger, and demand for autos is not super strong anymore. A lot of people, especially in my age demographic or younger, don't even really want to buy a car. They want to use Uber or Lyft or take public transportation and live in a major city. So do you think this is going to eventually put a large problem in the auto market, and so all these subprime auto loans are going to cause, a U word here, they're going to spill over like subprime housing did? Do you think the subprime auto loan market, that could happen in the near future?
Yeah, and I would say that subprime auto is a bit like a Ponzi scheme, and I wish I had some of the recent stats in front of me because they're alarming as far as the number of cars that are traded in these days where the trade-in value is less than the loan on the car, but it doesn't matter because they just throw whatever's left of the last loan on the new loan. And basically, the buyer of that car and the borrower is never going to get the car paid, right? And one of these days, finance will tighten, and then that person's going to get stuck with that car because they're not going to be able to buy the next one because the loan is too big. It's bigger than the car's worth. So yeah, I mean, that's one of the things of this cycle that will come back to bite is subprime auto. Yeah, I mean, it's egregious what is going on in that space as far as just lending to anyone, no down payment, all the things that we should have learned is, from past cycles is problematic. But again, we just continue to do it. And this time, we extend the life of the loan even longer than before. So the situation gets worse.
Do you think the car companies are doing this intentional then to pad their revenue numbers, where to say, oh, we sold so-and-so cars, even though there's channel stuffing and they're not requiring their dealers to put any money down? What do you think there's fraud there intentionally by the auto companies and also by the subprime auto financing company?
Well, I would also say that subprime lending, and that's autos, That can be credit cards or, homes. There's no business where you can grow revenues faster than subprime. Because if you lend to someone that no one else will lend to, they're going to borrow it. And you're going to charge them above market rates. And your profits are going to look really strong in that loan as long as it doesn't default. So we're in one of these credit cycles now where it looks profitable, although, we're seeing cracks in subprime auto, but it seems reasonably profitable to lend, and it boosts sales and, worry about the problems later. So I don't even say it's fraud. It's just the same kind of credit cycle where as long as you're growing your receivables, that book of business looks profitable. But as soon as you slow your growth, then your previous bad loans catch up to you rather quickly, and then you have to admit that you've got a lot of losses embedded in your loan portfolio, and that's coming. It won't be too long until we start to hear more about that.
That sounds very similar, Doug, to the leverage short volatility trade, which hedge fund manager Christopher Cole of Artemis Capital says is over $1.5 trillion in size. So it sounds like the subprime auto lenders, the business is going to work for them until it doesn't. So they're going to make really nice profits until maybe for a few months stretch, they just have an enormous explosion in defaults, just like the subprime housing. And then, the housing prices dropped and people couldn't refinance it and things are going to blow up. So it seems like they're taking a lot of high risk and they're getting kind of a high reward for right now, but eventually that reward is going to go away. Is that what you see as well?
Yeah. And what happens is, defaults start to rise, and then the lenders get nervous, and then they tighten their credit conditions. Then less people can get credit to buy a car, and then their book of business slows, their growth slows, and then those previous loans, the losses catch up to them. So it's more gradual than all of a sudden they're just hit by an explosion of defaults. That could happen if we had a financial crisis, an economic crisis, but the normal part of the cycle, it takes a little while for growth to slow and those previous bad loans to catch up to you. But, it always catches up. It's just a matter of when.
Yeah, there's some companies like Allied Financial and CarMax that are involved in this, and that is their business. So right now, those stocks haven't crashed yet. They've had a little bit of a correction, but we'll have to see what happens in the near future, because I'm thinking there's going to be a lot more volatility in those shares. And if they do have an explosion, like you said, in the defaults, those companies could be like the Countrywide, what happened during the subprime, how they'll either need a bailout or the bank pretty quick.
Yeah, it can happen quickly. In the marketplace right now, I know last week we saw significant outflows from corporate investment grade mutual funds and the high yield. So now if we start to see money flowing away from corporate credit, then I would expect we'll start to see widening spreads. We'll start to see some investor nervousness at the periphery of corporate credit, which would certainly include subprime autos. And all of a sudden, if the securitization marketplace slows, if there's less demand for these asset-backed securities that are comprised of all these subprime loans, then that's the turn in the cycle. So we could be seeing the early signs of that right.
Do you think that higher interest rates, if the Fed continues to raise rates, I think they've promised three rate hikes in 2018 Fed chair. Do you think that would accelerate an end credit cycle? And also, do you think the bond market's now in a bear market?
Yes, I'll answer the last question first. Yes, I think the bond bear market has begun, and this is after a very long bull cycle. You can go back 30 years if you want. So I think the cycle's turned. The Fed now has to move to tighten financial conditions, at least some. They're expecting to do 3 rate hikes this year. It could be 4. It could be 0 if we get into a difficult market environment. But right now, inflation is starting to tick up. The Fed's feeling the pressure. In the meantime, in Washington, there's this mindset in Washington that deficits don't matter. So our deficits are going to get even larger. The dollar's been weak, so international investors may lose their enthusiasm for holding treasuries. And, there's significant corporate issuance coming. So there's a lot of supply and demand dynamics that are changing right now that lead me to believe that we've started a bear market, and it could be a rough one. And I would expect it to be a rough one only because the excesses during the boom were so significant. We still have a large amount of QE coming from the Bank of Japan. We still have QE coming from the ECB, although that has been cut and probably will wind down later this year. But at this point, there's still QE out there that keeps the wheels greased, but even that dynamic is changing. So there's a lot of things going on right now that would make me very apprehensive if I was if I owned bonds, especially on leverage.
Yeah, there's been an enormous amount of financial engineering with corporate America because, in my opinion, as an Austrian school economist, of these artificially cheap interest rates, and they've allowed well over $1.4 trillion in share buybacks, not with free cash flow, but with debt, in order to financially engineer, higher earnings per share. They're not growing revenues. They're not generating more free cash flow. They're not expanding margins the right way. They're doing it with financial engineering. The other thing is, Doug, that really worries me is with President Trump, it seems that, with these Trump tax cuts, that there was no corresponding cut in government spending. Private sector tax cuts are great. I love tax, but there was no corresponding cut whatsoever in spending. It seems he wants to spend even more money on the military, spend even more money on infrastructure. And so, from basically as long as Trump's going to be in office the rest of his first term, we're going to have $1 trillion per year in budget deficits. That's going to be the new normal. So, and didn't the U.S. Treasury, correct me if I'm wrong about this, but the last couple of years, didn't the Obama administration and his Treasury, didn't they delay about $1.9 trillion in additional spending that they could have went to the market and tried to raise that in Treasury auctions, and instead they've delayed it into Trump's administration? So they're going to be going back the next year or two, the Treasury Department is back into the market for a lot more debt that's needed.
Well, there's enormous deficits coming, for years to come. And if interest rates surprise in the upside, that only compounds the issue because we're going to have to finance this just enormous debt load that's built up, especially over the last 8 or 9 years. And let's face it, one of the consequences from central bank policymaking, and basically they pegged long-term interest rates at a very low level, flooded the world with liquidity. They ensured that markets quit functioning as a pricing mechanism, right? The price of finance is not determined by supply and demand anymore. The central banks created all this, the demand for debt possible. So there was no disciplining in the marketplace. Corporate America wasn't disciplined. Washington certainly wasn't disciplined. Governments around the world weren't disciplined. So that's where we are today, where everyone believes, okay, deficits don't matter and we can cut taxes and we can increase spending and everything will be fine. Well, I don't think it'll be fine. I think the markets do correct. They do adjust. And since they haven't been able to for the last 9 years, then when that adjustment comes, it's going to be a rather destabilizing event for the markets, and that's kind of the way we're heading, because I think the markets will discipline Washington because they're going to say, wait a minute, we don't want $1 trillion more of your debt every year. And I think foreign investors are looking over here and saying, wait a minute, why would we want to continue to play this game? So again, the supply-demand dynamics in the marketplace are changing, and I don't think many people are ready for it, and that's investors and that's the spenders in Washington.
But like you mentioned earlier, Doug, it seems that there is going to be no really perfect safe haven, because you mentioned earlier that Japan is also doing QE and they're trying to devalue their yen, and they're basically monetizing their Japanese government bonds. The ECB and Bank of Japan did an enormous amount of quantitative easing in 2017, a lot more than the Federal Reserve. Even larger than the Federal Reserve, the Bank of Japan, the European Central Bank, is China, the People's Bank of China. Do you think China now has the fastest growing credit bubble of any of those major economies?
Well, I've said in the past, Jason, that as an analyst of credit, I look at China in awe. I think their banking system's up to $38 trillion, and it wasn't that many years ago. I'll call it 8, 9, 10 years ago, it was at $7 trillion. Yeah, they're growing credit in China at a rate more rapid than during the peak of credit here in 2006. I think they had almost 500 billion of credit growth in January. The numbers are just off the chart. January is always an unusual month in China. They front load a lot of lending. But yeah, what's going on in China is just unbelievable. And it's one of these situations where not only has the rate of growth of credit, let's not put it that way, the amount of credit has grown rapidly, the quality of that credit has deteriorated just as rapidly. So you get this exponential spike in what I call, systemic risk. And that's what I also refer to as a terminal phase of credit bubble excess. And, that basically is a period of self-destruction, where the economy gets so maladjusted, the financial system gets so fragile that eventually you have some type of a crisis. The Chinese government, keeps holds tight reins on their economy and credit system, so they're delaying this inevitable adjustment. But that's another dynamic in this very fragile global environment, right? It's a global bubble, and China is certainly a major part of the global bubble.
I think China, helped save the global economy during the 2008 financial crisis with their enormous stimulus plan to buy all those commodities and, do the central planning and build the houses. That certainly kept a lot of firms, especially emerging markets that have commodity-heavy companies and construction companies and cement companies and stuff, from completely going bankrupt. But it seems that the People's Bank of China, their balance sheet was a lot better like 10 years ago when they had around $4 trillion in reserves, but they didn't have that much of outstanding liabilities and debt and credit. What has worried me is I've been reading these articles now about the shadow banking system and hearing about middle class or higher Chinese families that tried to earn a little bit of extra money and loaned out a lot of money in the shadow banking system and lost their life savings and less. So these are disturbing things when it all adds up. Do you think China, though, in the near future, not necessarily in 6 months or a year or anything like that, but do you think in the next couple years that China's going to have to do a massive devaluation of their currency? They're going to have to bail out the banks because of all those problems in the credit?
Well, yeah, I would expect a massive bank bailout at some when that bubble bursts. Jason, my view is right now the global economy is strong, not healthy, but it's not a weak global economy. So China, as long as the global economy stays this strong, they can continue along this credit bubble path. But if we get into a dislocation, let's say a global market dislocation, where all of a sudden the economy slows, then that's a very problematic scenario for China. Yeah, I would expect the next year, 18 months, 2 years, that there will be a crisis in China. But candidly, I've expected that the last few years. Their bubble has gone, longer into greater extremes than I thought possible. So it's difficult to predict when it's going to burst. But you see all the telltale signs of a system that's very vulnerable to that.
That's a good point. Yeah, Kyle Bass has been in your camp, and he's been predicting. I think he's been shorting the RMB for 2 years, and he was at least 2 years too early. But it seems that China, as an Austrian school economist, China's in the boom times, the happy times of the credit bubble. So I've actually heard that GDP, which I think GDP is not a good measurement of real economic growth, but GDP is, what governments use to sell more debt.
Right.
So
Right.
China's GDP, I've heard, in 2017 was 11%. So they haven't had that in a very long time. So if that's true, they're booming like they haven't boomed in 10 or...
Yeah, and what didn't get a lot of attention last year? The government tried to tighten some of the local government finance. It tried to tighten shadow banking. At the same time, you had enormous growth in individual mortgage debt. So they're in their own mortgage finance bubbles that goes along with other bubbles throughout their economy. But the mortgage finance bubble in China is vulnerable because all of a sudden, if you get a downward movement in apartment prices, they're not homes, they're just their apartment. That's when you could get a rapid slowdown in mortgage credit growth. That's what happened here, in 2007, 2008. So there's a lot of vulnerability in mortgage finance in China because I think a lot of these apartments that have been built are very poor quality. I think there's estimates it could be 20 to 25% of apartments are vacant in China. We've had enormous new construction. A lot of their apartments have been bought on spec. So that's a bubble that could burst at any point. And when that bubble bursts also, I think you'll get another round of these, outflows from China, and that's when their currency will be under risk, a lot of risk. And one thing I'll throw out, I think there's also a possibility that there's a big global carry trade component in China. A lot of hot monies come into China just to play these yields, right? They're one place in the world where you can get 7, 8, 9% yields on a lot of lending. So if you got into a situation where all of a sudden the currency breaks on the downside and you have money trying to get out of these trades, that's the old emerging market crisis that we've seen repeatedly over the last 20 years. So that's I think a significant vulnerability in China that doesn't get much attention.
We'll be right back with Doug Noland after a word from our sponsor.
Do you work out routinely and eat healthy almost all the time? If you eat paleo or vegan or work out routinely, you may be eligible to save up to 33% off on your life insurance thanks to Health IQ. Health IQ is a venture capital-backed, big data technology life insurance company that offers customers life insurance at special rates by using the latest technologies. For more information, please go to healthiq.com/2 WS, the number 4, MS. That's healthiq.com/WS, the number 4, MS. Legendary short hedge fund manager Jim Chanos, he did a presentation recently about his new short position in China, and he's short a lot of the Chinese housing market, the developers, because he says about 60% of China's GDP is based on speculative purchases of luxury houses, that Chinese families are buying these things, their savings, and betting that the price will continue to appreciate. And so they're not living in the houses, they're not actually using the house, they're just using it to park savings there and betting that this is a safe place to park savings and that the price, so he's short that large trend.
Yeah, that I think that's absolutely right. I agree with that completely. And I think, one way to look at it, you've had tens of millions of Chinese become very wealthy in real estate, and you have hundreds of millions more that would like to do the same, right? So when you have loose finance like you've had over there, the family will pool its money, whatever it takes, they'll get, the borrowing necessary to buy that extra apartment to hold as a speculation. And that's happened, throughout the country, small markets, big markets. And that 60% of GDP number, that's frightening, but that could be the case.
Yeah, and Chanos, to add to that, Chanos also said that not only is that 60% of China's GDP right now, he also said that the Chinese housing market, that portion of it is 2% of the entire global. So it's a very, he said that's actually the largest chunk of any part of GDP, he said, is that. So it's really ballooned in size, the last 10 or 15 Chinese housing market. It's very interesting, what's going on in China. I agreed with all the logic that Kyle Bass put in, but it's just, I guess with the timing and the rules changes in China, that they can delay devaluation. Their last devaluation, Doug, was 2 years ago? No, 2015, so now it's 3 ago. And so it was a pretty decent devaluation, but a lot of economists think that they're going to have to devalue their currency again by 15 to 20%.
And their reserves over the last few months have started to grow again, and they continue to run, enormous trade surpluses. And they're benefiting from this maladjusted global boom. But again, when the backdrop turns sour, that's when their currency will be vulnerable.
So let's transition now and let's talk about asset price volatility. There was a huge spike in the VIX recently. The VIX went up over 120% in a matter of days, and then it crashed again 20-something% in one day. The VIX right now, I have my screen up. The VIX is down to 20 again, which is reasonable. It was at like 9 or 10 a couple months ago, so it's still up quite a bit, but it's not in the 30 or 40 territory, emergency territory. So what's your opinion about volatility, asset price volatility going forward? Is it going to be back again, or is this leverage short volatility trade that is one of the most overcrowded trades in finance and on Wall Street? Is that trade, people are going to stick with it, they're not going to give up on it? So you think they're going to try to continue to short volatility and money?
Yeah, I mentioned global central bank policymaking encouraged governments to issue as much debt as they wanted and disregard spending and whatever. That's one of the consequences of the bubble. Probably an even more important consequence from central bank policymaking has been this short vol trade, where I talk about it's like writing flood insurance during a drought, right? If central bankers are going to backstop the market, if they're going to ensure the markets are liquid and not allow a significant pullback, then why not go out and sell the VIX? Why not go out and basically invest in any product that's riding market insurance? And of course, if this goes on for a spell, as we've seen for the last 8 or 9 years, then Wall Street's going to, they're enterprising operations. They're going to come up with all these different products and strategies to basically play the same theme, right? Market insurance. So that's what we've had. And you had enormous amounts of money coming into this market, coming into these products, and that reduced the price of market insurance. It became very easy to just go out and buy a put to protect yourself because it was so cheap and liquid, right? So that led to enormous distortions across the securities markets. Why not leverage? Why not push the risk envelope when the market's going up if you can buy cheap risk protection? Well, I'll say now, the past few weeks, we finally had some torrential rain come, and people decided, wait a minute, I don't think I want to, sell market insurance. So they try to unwind these trades, and people get really hurt, and the VIX spikes. I think it made it to almost 50. I think this is a major market development. I think this ends this period of cheap flood insurance. And without the cheap flood insurance, it's going to be a lot more expensive now to build a home along the river, as my analogy from years back goes. So I think we will have much more volatility now in the markets. I think these volatility products are a big problem. And of course, people are going to rush in to sell the VIX spike because it's worked so many times over the years. But this time, I don't think it's going to work for them, because I think the sophisticated players now know that the environment's changing. They see the volatility in the currency markets. They see rising bond yields, more volatility in corporate credit. So they're now in the mode to take less risk, take off some leverage, and that is an important change in the market environment. I've made the comparison between short vol and subprime. Short vol blew up, a couple of weeks ago, and I talk about subprime when it first started to blow up back in late June of 2007 with the blow up of a couple of Bear Stearns structured finance funds. So the market back in 2007 kept going for another 15 months until the financial crisis, because bond yields, still could decline, and the Fed had a lot of flexibility, could cut rates. This time, I don't think it lasts 15 months from the blow up of short vol to a financial crisis, because bond yields are going up and the Fed doesn't have much flexibility. But anyway, I really think the game has changed in the markets now.
Now, you said that central banks were involved. Does that mean that you think that central banks started initially maybe in 2008 and 9 when they were coming up with the QE programs, that not only were they going to add liquidity to the markets and try to get the wealth effect and move the asset prices higher, but they were also going to try to go and actively plunge protection team or whatever trading they do in the markets, they're going to go in there actively and actually start shorting the VIX and shorting and doing short straddles on the major stock indices? Do you think they're actively going in there and trying to manipulate the markets, and then Wall Street piggybacked on that?
I have no idea. I sure hope they're not in playing with the VIX, but we know that they went out and bought trillions of dollars of sovereign debt. We know they bought, the Fed bought, $1 trillion worth of mortgage-backed securities, and that injects liquidity into the marketplace. We know that central banks had repeatedly backstopped the markets, basically signaling, and I know in 2013, Bernanke signaled, that the Fed would push back against any tightening of financial conditions, basically saying, hey, if the markets start to tighten up, if there's a decline in the markets, the Fed will react to it. So what my point was that the central banks they have been controlling the weather and basically saying, we're not going to allow any floods, we're not going to allow any market problems. So there was a rush to go out and make easy money from selling the VIX or selling any type of market insurance. That was my point. That the central banks monkeyed with the market mechanism by dampening volatility, by underpinning prices, and basically promising that the markets would go higher over.
Do you think then that we're headed towards a 1987 style crash? And the reason I bring that up is when I wasn't in markets, obviously 1987, I was only 5 years old. But when I read about the 1987 crash, that everyone had portfolio insurance, right? And everyone thought they were safe who was a financial professional because they had portfolio insurance. So do you think then if this VIX trade does blow up, that it could have, a similar type of 1 or 2 day event similar to the 1987 crash?
That's certainly a possibility. The derivative issue today makes 1987 look like nothing, right? You can't even compare the short volatility trade to, portfolio insurance in 87. It was small in 87. It was an important part of the market collapse because of the forced selling into weakness. But the issue today is it's across asset classes. It's global as far as, cheap market insurance and the distortions we've seen, corporate credit, the emerging markets. It's global. It's everywhere.
Now, as a portfolio manager and someone who's managed money for a long time, how do you feel about these leveraged ETFs? Do you think a lot more of them are going to blow up like the XIV? Do you think ETFs in general, there's problems with them, or do you think it's mostly just these leveraged?
The ETF complex, which now is at $5 trillion globally, I believe, it's another one of these consequences from global monetary policy where, why not just buy an index? Why worry about sending money to an active manager? Because that active manager may actually respond to risk and reduce exposure and underperform an index. So, the Fed, global central bankers, by bolstering liquidity, bolstering markets, and basically punishing anyone who looked at risk, they've led to they spurred enormous flows into passive management, where everybody, and this this is just speculation, right? Nobody is investing. You're not buying an index as an investor. You're speculating that that index goes higher. And also what we've done is we've transformed a lot of illiquid securities, and that can be small cap stocks or it can be corporate credit, and we've converted them into liquid ETF shares. And that's a real problem too. And I've referred to this concept of the moneyness of risk assets. We've turned a lot of risky assets into perceived safe and liquid instruments, which to me is very dangerous. There's misperceptions in the marketplace, and it leads me to believe one of these days that when there's significant outflows from the ETF complex, there's going to be liquidity issues in the market. And what makes this even more dangerous is all of a sudden, if there are big outflows from the ETF complex, you've got a $3 trillion hedge fund industry that's going to be opportunistic and try to jump in front of ETF selling. So the markets have benefited from $6-7 trillion worth of trend following money during this long bull market. But all of a sudden, if this trend following money turns negative and tries to get out, that's an instant recipe for dislocation and illiquidity.
To my knowledge, Doug, there hasn't been a regular ETF that's blown up yet, but there has been some problems with some regular ETFs. The main one that my listeners will know is the gold mining stock ETFs, like the GDX and the GDXJ, when those were rebalancing. And so the fundamentals of each of those gold miners in the index, in the mining stock, gold mining stock indices didn't change, but the shares just dropped 10 or 20% because the ETF owns so many shares of each miner in the index, and when they rebalance, they just indiscriminately sold them and dumped them all.
Sure. Yeah, and there were issues in the ETF area back in 2008, but we didn't learn a lesson from that, unfortunately.
I don't think the ETFs were nearly as popular then. I mean, they were starting to become popular, but I think more of these high frequency trading algorithm hedge funds and day traders, more of those funds are now trading these ETFs. I think the growth in ETFs has been enormous the last 10 years.
Absolutely, no doubt about it. I mean, I think there was like almost 500 billion positive flows into ETFs last year, and I could be, I don't have that exact figure on them written down in front of me right now, but enormous number. Enormous.
I think it might even be more because of a lot of that central bank liquidity in other countries. I think a lot of it's gone into the regular stock market ETFs, and a lot of it's gone into the FANG stocks. I mean, the FANG stocks seem to be like one of the most overcrowded popular trades on Wall Street as well, long FANG.
Sure, my number was just a U.S. number. Yeah, the global numbers, absolutely.
Yeah, I think there's a lot of money that's leaked out of China and Japan and Europe and come to the United States and into the capital markets. And the Fed, the Fed hasn't done a lot of stated QE in a while, but because the Fed was raising rates and the U.S. is still perceived as a safe haven relative to other countries, the U.S. has benefited from this. I don't know if you saw my buddy Brent Johnson. He did a video last month. He showed a milkshake with a straw. So the Fed didn't do QE, but they just sucked up other countries' liquidity instead. They basically drank other countries' milkshake liquidity.
Yeah, I like that analysis. Absolutely. Yeah, and that, you can see it in the Fed Z1. We've had enormous inflows of foreign-sourced money into U.S. security markets, and a lot of it clearly is from QE, either directly or indirectly.
So a couple more topics in this interview, Doug. Oil is above $61 a barrel, but do you think that in the next couple of years there's still the possibility, the high probability of the U.S. shale oil bubble collapsing? Because a lot of these oil producing companies, they have high production growth, but they're not generating free cash flow. It seems they've grown their production just with more and more credit.
Yeah, absolutely. And that's one area where if credit conditions tighten, especially if they tighten quickly, the shale producers are in the line of fire because, they're big borrowers. It's not a space that I follow that closely. It's amazing the amount of production that they've been able to receive, and it's hard to tell exactly how much of that has been related to just the loosest finance imaginable, but clearly loose finance has played a major role in the shale patch.
Yeah, it's a combination of factors, I think, Doug, why the shale companies have gotten so much. So there has been technological breakthroughs. They have been able to lower costs because initially the shale producers could not produce oil for a profit below $75, $80 a barrel. Now I think most of them can do it in $45, $50. They can produce like somewhat of a profit, but they're not consistently generating free cash flow. The other one is, with all these central banks doing financial repression for so many years, that they made pension funds and all these other and all these other entities, retirement people that needed income, they were willing to go out and finance some of this junk bond in exchange for yield. So, maybe in the short term they are paying off the junk debt, but it is very worrisome that you're relying on income from junk debt.
Absolutely. Yeah. Good point.
Yeah. So the last couple questions about the junk bond market. The junk bonds haven't collapsed yet. They've been used for share buybacks. What are going to be some of the signs that the junk bond market is breaking?
Well, we've seen the last few weeks, especially the last week, we've seen outflows from junk bond funds, so that's certainly important. We've seen some widening of spreads. It started, so we'll be watching spreads closely. We'll watch to see if we see many deals canceled, and all of a sudden, if we start to see deals canceled, then that'll be confirmation that the environment's changed. In the past, we've had bouts of outflow that then reversed as risk on returned to the markets, and then the inflows came back into the junk bond space. But I think this time, especially if equities have started kind of a bear move here, I think we're all set up for problems in junk bond. We're all set up for it.
As someone who in the past, in our past interview, you said you actually do the research and look for individual companies to short. Do you short anything just on valuation, or do extra research and look for something with a really bad balance sheet, with too much debt, deteriorating cash flow, deteriorating margins? Just maybe outline what your checklist is for doing research for something to consider for shorting.
Sure. And shorting stocks has been extremely painful now for about 9 years, right? Since the Fed started QE, loosened financial conditions, corporate credit conditions were loose. That's always a very tough environment for stock picking. If you start to see a tightening of financial conditions, that's when stock picking on the short side can be very fruitful, especially if you start to see significant tightening in corporate credit. I like to look at extended balance sheets. You want to look for negative cash flow companies that have financing requirements, have maybe aggressive growth plans, and then all of a sudden, if they're not able to tap the markets, those growth plans are suspect. I haven't, it's been a while. It's been quite a while since I've had that line of analysis and focus in the marketplace, but I think that's starting to unfold. This is just kind of a traditional old school, I've been on the short side going back to 1990. That type of analysis at times works very well. At other times it doesn't work well at all. But again, it works. It can be very effective. I think back to 1990 in particular, with financial conditions tightened. 2002 was a great year for picking weak balance sheets. And then, 2008 also, when financial conditions tightened.
So at the McIlvaney Tactical Short Fund that you run, you don't have a lot of positions open. You're in a lot of cash right now. You're waiting on the sidelines for things to start eroding first, to see more signs of a downtrend in the share prices before you start to go in?
Yeah, and what we have are separately managed accounts. We don't have a fund. It's separately managed accounts, a tactical short. We have short exposure that we've been building, especially the last few weeks. But right now, I am not short individual company stocks. It's more a focus on the market, because I think when you're playing for a market reversal, I'm going to play it with more market instruments and then expand my short exposure as financial conditions tighten.
That's very interesting. So last question before I let you go. In my opinion, I think one of the longest term trends right now, I think as an Austrian school economist, I see, unfortunately, central banks and governments trying to put on a lot of regular people in the middle class. There's more inflation with devalued fiat currencies, and also taxes going up despite the Trump tax cuts. There's taxes on a lot of other things in people's everyday lives going up. So do you think then one of the biggest long-term trends that maybe someone who's looking to short can do research on, is a declining discretionary income for the U.S. middle class?
Yeah, I think that makes a lot of sense. And just from a bubble theory standpoint, bubbles are about a redistribution, destruction of wealth, and it's always the middle class that gets hurt the worst. The working class, a lot of times, they don't have a lot of money in the asset markets. The wealthy figure out a way to protect a lot of their wealth, so it's the middle class that kind of gets hung out to dry. But I'll also say, Jason, that I don't really recommend individuals to go out and short. It's tough. It's risky. But I would agree that could be a really fruitful place to look over the coming years.
Yeah, because I live in one of the three highest average median family incomes in the entire country, and I drive around quite a bit. So on Friday nights and Saturday nights, I check out movie theaters, the parking lots. I look at parking lots for normal, middle class, sit-down, casual dining restaurants, and then I look at mall traffic. Besides, I live near one of the larger malls, but I do check out other malls and strip malls and things like that. And a lot of these things, Doug, are and you would think, in the area I live in, that people would have discretionary income. They're not going out, they're not eating, they're not going to as many. So I maybe some of these companies are bucking the trend. I'm sure there's some restaurants that are doing well, but the majority of them, I see empty parking lots, and I think for a lot of retail companies, I see that as well.
Yeah, and that's that earlier theme we were talking about. It doesn't get enough attention. I think we have massive overcapacity throughout the consumer space, and that's, you mentioned the casual dining, retail. It's throughout the whole sector.
Last question. I don't have this down in my notes, but I want to get your view on this. So someone who looks at credit bubbles, what's your view of the cryptocurrency space? So there's no actual debt there yet, really, but it's viewing this as a new technology. There's a lot of fraud in the initial coin offering markets. There's problems in the altcoins. Some of these altcoins, not all of them, but especially the initial coin offering market. So what's your view on the cryptocurrency?
Well, my general view on bubbles, I mentioned, they end with this terminal phase of excess. And I say that things get really crazy at the end. And we've seen that, in 2006 with subprime CDS, and we saw it in, 1999 with internet stocks. So to me, I look at the cryptocurrency as just a sign of the times. To me, it's just part of the craziness. Not a lot of value there, not a lot of real wealth there. And I think at the end of the day, a lot of people are going to lose a lot of money in the cryptocurrencies, and some people are going to make a lot if they were in early. But I assume blockchain's here to stay, but I think the cryptocurrencies, it's late cycle excess to, in a historic bubble.
Yeah, it's tough to figure out the value of these things. I'm actually not very, I don't know about you, but I'm not very technologically savvy. So trying to learn these things on the fly about the different altcoins and stuff has been very difficult.
And I'm not spending much time there because to me, it's not a fruitful place for my time to spend. But if everybody thinks that these things are going to hold their value over time, then they can play that game. I'm just kind of a hard asset guy. To me, I'm suspect of financial assets generally going forward, and I look at Bitcoin and cryptocurrencies. They're at the fringe of financial assets. So people say that they have value relative to government fiat, but to me, it's just electronic fiat. So to me, it's not appealing.
Yeah, I prefer gold and silver, but I do own some cryptocurrency as well, just in case for diversification purposes. I also have some cash, just in case there is a market crash and things go on sale that I want to buy. But, I know you're known as more of an analyst for the short side, but is there any asset class or sector of companies you think that are undervalued right now? Or is there just because of the everything bubble and all this credit exploding that there's really no bargains right now on the long side?
I don't see a lot of bargains on the long side. I look at the world and I think, precious metals will be a good store of value, a safe haven. Other than that, as you mentioned, I'll hold cash, but I'm not out searching for bargains, and I'm hoping to have cash to take advantage of bargains down the road.
Yeah, this is the central banks, Doug, have distorted things so much in just the last 10 years. I started paying attention to markets in 2007 and 8. And, the rules, as someone who's been in markets a lot longer than me, it just seems to me that the people in power in the treasury departments and the central banks, they're constantly changing the rules. There's nothing fair about what's going on. And it's making even professionals' jobs like yourself a lot more difficult.
Oh, they've totally distorted the markets. It's very, very difficult to do the type of analysis we would like to do. But it is what it is, right? And again, I think this is the greatest period of financial excess in history. I thought 1999 was crazy, and then 2006, 2007, and this makes those look pretty small, unfortunately.
Well, in terms of stock market valuations, it is in the top four. So 1929, 1999, 2007, and now. And the basically, the Federal Reserve has been heavily involved. The Federal Reserve wasn't super involved in 1929 as much as it was in all the other three major stock market drastic overvaluations and bubbles. So the Fed at least had some constraint back then compared to now. But it's gotten crazy. I think, not only is the Fed actually hasn't been the main one doing all the problems. It's been all the other central bank coordinating and intervening. The explosion in China is really worrisome. So I think they're in their boom phase, the happy phase right now of their boom, but they will have a bust at some point. It's just, as you know, with a short, and you've shorted a lot more than I have, the timing of these things, even if you nail the fundamentals, the timing is by far the hardest.
Yeah, these bubbles, I make this, joke where I say, bubbles go to unimaginable extremes and then double. And it is really the truth. So yeah, the timing on these bubbles is extremely difficult, if not impossible. Keep in mind, Jason, that Chinese stocks got hammered, week before last when U.S. markets were down. I mean, it was confirmation that all these markets are highly correlated. They certainly act like it's a global bubble, and to me, they act like we've seen the first significant crack. So it's going to be interesting to follow over the coming weeks and months, no doubt about it.
Yeah, I think all these trading computers with high-frequency trading algorithms and how fast the internet connection and speeds is going and how sophisticated the trading software is getting has correlated all these things. So, if a currency moves one way or another, the trading program is taught to buy this, sell that, do complicated spreads or yen carry trades and things like that. So the average person doesn't really understand all the mechanics that are going on in the market, and it's gotten more and more complicated with the technology that's used in trading.
Absolutely, and I would just throw out, global carry trades and global leverage speculation. That keeps the liquidity flowing to all the markets simultaneously on the upside and the downside. So yeah, it's one highly correlated global bubble at this point.
Well, Doug, I want to thank you again for your time. And if our listeners want to follow your great financial blog, which has been around pretty much longer than any other financial blog, the Credit Bubble Bulletin, and maybe take a look at your McIlvaney Tactical Short Fund, how do they do so?
Yeah, and you can always just search my name on the internet, or it's creditbubble.com or creditbubbleblogspot.com. But thanks for the kind words, and nice chatting with you, Jason. Thanks a lot.